Welcome to our journey to safeguard ourselves from stock market malpractices. This video highlights market abuse practices which adversely affect the financial markets. Market abuse practices. In our pursuit of financial well-being, understanding market abuse practices is vital. Let's explore these malpractices that demand attention. Today, we will shed light on these topics. Types of market abuse practices. Front running. First, let's talk about front running. Front running is a dishonest or trading practice based on advanced knowledge of impending large trades or recommendations. The one who trades before is called front runner, and the one who is about to place large order is called big client or big order. There are chances of matched trades between front runner and big client. Imagine you have a big client B who is about to make a huge purchase of a particular stock PQR Limited, and this will make the PQR Limited price go up. Now, another person F gets wind of this information and decides to secretly buy that stock in his own account or in the account of friend or relative before the big purchase happens, and then sell the same after price upward movement either on same day or in few days. F is essentially trying to ride the wave of the upcoming price increase to make a quick profit. This sneaky move is what we call front running. It's like F is running ahead to get the benefits before everyone else catches on. Similarly, there can be short selling by front runner and square off intraday against sale transaction of big client. Who can be possibly front runners? Dealers, sub-brokers or authorized persons, officials of big client, fund manager, etc. Synchronized or matching and reversal of trades. Now, let's talk about synchronized or matching and reversal of trades. This deceptive trading involves individuals or group manipulating stock prices through abnormal or non-genuine trades, leading to artificial volumes that can mislead investors. Generally, to execute synchronized trades, both buyer and seller place and modify orders within few seconds difference to each other. In simple terms, consider two traders, A and B. They engage in synchronized or matching and reversal by first having A buy a stock of, let's say, XYZ Limited from B, creating the appearance of legitimate trading. Then they reverse the trades with B buying back from A. Despite no change in ownership, they have generated artificial volumes and transferred profits or losses between themselves. Such deceptive trading, often driven by motives like tax evasion, can mislead other market participants. So, who can possibly do synchronized or matching and reversal of trades? This usually includes group of clients associated with each other involving single or multiple brokers. Next, insider trading. Now, let's talk about insider trading. This happens when individuals use advanced knowledge of unpublished price-sensitive informations, UPSI, for personal gains by directly or indirectly trading the script of such company or associated company. Consider you work for company LMN Limited, knowing your company will announce a groundbreaking product. Using this non-public information, you decide to buy LMN Limited shares in your own account or in the account of friend or relative before the official announcement. A classic case of insider trading. It's important to note that insider trading is not just unethical, it's illegal. Insider trading regulations aim to maintain a fair playing field for all investors, preventing those with privileged information from gaining an unfair advantage. So, who can possibly gain from insider trading? Key managerial personnel, vendor, supplier, client, auditor, employee, and their friends or relatives or accomplices, etc. Some may also front run an insider and earn unfair gains. Next, circular or watch trading. Now, let's talk about circular or watch trading. It is a misleading practice creating artificial volumes and a false market buzz. Traders collude to repetitively buy and sell securities without changing ownership, influencing perceptions of liquidity. Imagine three traders, X, Y, and Z, aiming to artificially inflate the volumes of a stock, let's say ABC Limited. Here's how it unfolds. X sells ABC shares to Y, who sells it to Z, and Z sells it back to X. Notably, all transactions occur at the same or similar price and with same or similar quantity. In this orchestrated circular trading, there is no real change of ownership or economic gain. Yet, the impact is significant. Others perceive these transactions as more than usual, creating a false sense of significant volumes. This deceptive burst tricks participants into thinking there is genuine interest in the stock, tempting them to join in. The goal is not just to inflate the stock price but also to create a false sense of liquidity, especially for investors and traders seeking it. Next, marking the close or fix. Now, let's explore marking the close or fix. Here, traders intentionally buy or sell a share during specific times, like the market close or an intraday cutoff time, to create a favorable artificial price. Imagine a trader A who wants to make a stock X Limited appear more valuable than it is. Just before the stock market closes for the day, A strategically buys a large number of shares of X Limited. It is important to note that the closing price of a stock is calculated as the weighted average price of the last 30 minutes. That is from 3 pm to 3:30 pm. Such buying directly influences the close price. By doing this, the artificially increases the closing price of X Limited. This can mislead other investors who might think the stock is doing better than it actually is. These practices may mislead others about the stock's value. Investors should be aware to make informed decisions. Understanding how traders manipulate closing or fixing prices helps investors navigate the market with clarity and protect themselves from potential distortions. It's worth noting that marking the open price is significantly influenced by pre-open sessions introduced by the exchanges. Next, pump and dump. Let's delve into the manipulative strategy called pump and dump. Imagine there is an investor J with 40,000 shares of company A Limited, worth Rs 0.1 per share. To pump, J generates excitement by spreading false news of a revolutionary invention. People intrigued by the buzz start buying the stock, boosting its price. Now, in the dump phase, J sells 1,000 shares at Rs 1 each, followed by 5,000 shares at Rs 2, then 10,000 shares at Rs 3. Finally, he sells the remaining 24,000 shares at Rs 4. J earns Rs 1,37,000 on his Rs 4,000 investment, exiting the stock he artificially hyped. The danger unfolds when people realize the invention was false. In the aftermath, there are no buyers, leaving investors with worthless shares and significant losses. Stay informed and vigilant to defend against all market abuse practices. Let's contribute to a fair and transparent financial market. Thank you for joining the educational journey.
Investments in securities markets are subject to market risk. Read all the related documents carefully before investing.